The put side is very rules based. We have some discretion that we use on the call side, which we can talk about that
Hmm.
later, how we actually approach. But I think that's how retail versus the product would differ most, is in a leverage type situation or a structure type approach.
Yeah, and actually, I'm kind of interested in that now. So the puts have a very, very rule-based plan, but you have a little bit of discretion, I guess, with covered calls. How does that work?
So the way we engage the positions, again, by prospectus, we wanted this to be something that people could expect, right? We're going to diversify. If you look at some of these other funds in our basket of derivative income, they might do one or two things, or they might specify, or they might lever, or whatever. The goal of this product was it to be a core position, something that you could hold that had several forms of diversification, which I can step into that for a minute actually. We're going to diversify across asset class, but not only asset class, across time.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, wealth building family. Today we have a very special show because we have a very special guest. Our guest today is the co-founder of Peerless ETFs and portfolio manager of the Peerless Option Income WEEL ETF, trading under the symbol WEEL. Together with his business partner, the duo developed, refined, and brought to market a first-of-its-kind patent-pending derivative income ETF designed to systematically implement the full option wheel strategy. He brings a distinctive combination of engineering discipline, options market expertise, and portfolio management perspective to the firm's rule-based investment process. Please welcome Rob Pascarella. Rob, welcome.
Thank you so much, sir. Awesome to be here. Thank you. Thank you.
The honor is all mine. I'm super excited to talk with you today. So, Rob, I was lucky enough to get a little teaser of this story the other day, but I'm just dying to get the full gloves off version here. You started off as an engineer. How did you get to being a portfolio manager at a wheel strategy ETF? Connect those dots for me.
It's a pretty fun story, and we're pretty proud to tell it. So, first of all, thank you so much for having me. It was quite an honor that you actually outreached. We spent all this time like trying to gain traction, and that you actually wanted me on was an incredible moment for me. So, thank you so much. Well, I want to be clear too. We're not Tarantinoing it here. We're not starting at the end, and that we're certainly still in the early stages of the life cycle of this thing, and it's fun to tell the story, but we've got a lot of work to do yet as well. I started as probably anyone interested in the markets get started, is just by inquiry, right? Like, oh, what is this part of the market? What is a future versus an option versus a stock versus, you start getting interested in the space, and then you find something that might strike a key with you and say, hey, this is really resonating. And for me, that was derivatives. So as an engineer, and there was a lot of tinkering and understanding how these products work and function. And well, it's really just math. As I told you the other day, it just kind of resonated with where I was as an engineer in that space. And I happened to be a turbine troubleshooter as a profession. And as a youngster, I was always stuck on night shift. So at the time, you're like, this is a bummer. I'm always on nights. So I don't have no life as a 20-year-old kid, trying to learn this stuff. But as I grew through that, I'm learning my profession. I just also kept studying the finance industry as well. And so that allowed me to do was, yeah, I was stuck on night shift, but get up and watch the afternoon session and watch the close or start trading on my own a little bit and then go into work and get a little bit of sleep in the morning and do it the next day. So I think it was a combination of finding what resonated with me and also utilizing that energy to just continue drilling down through that path and eventually developing my own process out of that education.
A lot of both professional traders and even some of like our market taker mentoring student traders, they have an engineering background.
Yeah.
It's a common thing.
Yeah.
So, how has that engineering background influenced the way you think about markets and risk?
I think a lot, especially retail, and I saw it in myself when I got started. You kind of learn what's out there or what people are teaching. You have to find something that resonates with you and that gives you that energy to really understand it from first principles enough to make it your own. And I think that's where the engineering background helped me was not only a disciplined approach, a structural approach, but getting out of my own head as a retail trader, like, oh, that didn't work. I have to instantly fix it is kind of what, a young trader might think. An engineering approach says you may get stopped out. You may have something that is temporarily not working in your strategy. But if you've done that research, if you've studied enough over a long period of time, the law of large numbers will say this process is going to work for me, or you have belief in yourself enough to make those iterative changes. So I think the engineering background, not only mathematically, but procedurally, is what really drove me out of a headspace to thinking at it systematically.
Oh man, I love that. Yeah, because people who don't have that way of thinking, I guess, the psychology gets in the way. And
Huge,
yeah.
huge.
So, is this the first ever wheel ETF?
It is. I think we're going to get into the story of how we got started later, but one specific feature was if you look at the derivative income space, almost nobody is selling puts. 98% of that category is covered call funds,
Mm-hmm.
which is interesting to us because there's aspects of this that are advantageous, put writing, probability wise, and also holding that collateral out of the moneyness we use. Structurally, we think an advantage for our product, right? So we think we had an advantage there, and we said, you know what? Who else is doing this in a public fund? And we went through the patent lawyer process, and it had not been done. So we started that process to try and put that little check mark by us. That was a pretty good learning curve there, but it was fun.
Yeah, that's cool. And I mean, you could have set this up as like mutual fund or just become registered investment advisor and manage people's accounts. Why specifically an ETF then?
There are lots of form factors, functions, a way you can facilitate any strategy for a client, really, right? But we tried several forms, functions of that idea. And as we were doing this research, we knew we wanted wheel as part of the name.
Mhm.
And we just one day checked to see if the wheel ticker was available at WEEL, and it wasn't being used. So Eric and I were like, we have to do this. It's got to be an ETF. But we did go down the mutual fund route briefly because there's no intraday kind of action to watch. You just strike your NAV at the end of the day. It's certainly easier to track who is in and out of the product in that form. But we felt WEEL, which Eric, by the way, is the king of dad jokes on everything is wheelie great. But yeah, we knew we needed a packaged product. Felt, especially the derivative income space was heating up at this time. We had the name, we had the product, so we went for WEEL as an ETF.
Wow, that's cool. Just great timing too. So the other day, I believe you mentioned that you've done some back testing as part of
Sure.
your research. Yeah. What did your back testing reveal that surprised you the most?
what I want people to understand that this was a parallel path with forward testing as well, right? So we try and back testing, I think, comes with a certain stigma if you mention it and under certain umbrellas. But I think it was an important part of the process because through, again, this iterative function of how we got to where we got, the first piece of advice we got was start a GIPS compliant track record. So what does that mean? Well, we started just a bucketized, which was actually a hedge fund under our RIA umbrella that Eric is owner of. Started a bucketized approach to start that process and began forward testing our WEEL strategy, but also back testing through certain regimes of markets, doing the same structured process over time. Does that work? Can we tinker with allocations? Can we tinker with out of the moneyness, be it deltas or, an annualized return of some type on where we're selling the options in particular? There was a lot of tinkering able to be done. And where I think to answer your question directly, it really gave us insight as into what areas the derivative income would be most powerful or punch above their weight, I like to say, right? So across the board, if you allocate it evenly, what is really going to be an outperformer in terms of giving you that income? So I think that's where the back testing really helped me and Eric develop what the allocation sizing would look like.
What market environment do you think is the absolute best for the WEEL, and what do you think is the worst for the WEEL?
I'm going to start with the worst because that's actually where we started.
Huh.
So we launched the ETF in the summer of 24. And the second half of 24, as you remember, the market just took off. The latter half of 24 was a straight up environment. We started the fund, we were all cash, so we just started selling out of the money puts, right? And they expire, great, you keep your premium, but the market is running away from you and you're just keeping your premiums. And we collateralize, and so you're getting a little income on the collateral. But that was kind of a frustrating time because we kick off this thing, we're all excited about it, and the market just goes up and to the right, and our products not missing it. Again, we're getting that income. It was a nice rate of return, but it didn't match the S&P 500 during that time. This strategy is built ideally for sideways, or I even prefer a slight grind down in the market because our out of the moneyness that we're going to use in all of our underlyings provide that buffer. And if you're slow down, your puts are still going to expire worthless. You keep the premium, and if that is an extended market regime, that's going to be really good for us. So sideways to slight down is our best environment. The worst environment would be a Volmageddon or an insurrection day that we've seen, right, where all correlations go to 1 and we start slowly getting assigned names. And if it's slowly, that's great. If it's even quickly, that's great. But we want to have ideally some put income coming from somewhere in the portfolio. So if all correlations go to 1 on a straight down event, we're going to be assigned some names in the portfolio. We have to get long, and then we'd be in cover call rating mode. We're still going to be protected again on those first bit of loss from the out of moneyness of the short puts. But eventually, if the market just keeps going down and down and down, we keep getting names assigned, we get more and more long, and the product's going to drift down further with the market at that time.
Even now, when I'm trading my WEEL strategy in just my IRA, which I do every day, you see those days when the market's up 0.5%, and I'm like, oh, well, I'm only up 0.3%.
I'm not doing anything.
Yeah, yeah. And
Yeah.
but then you
Yeah.
get those days when the market's down 0.5%, and you're like, oh yeah, I'm only down 0.2%.
Yeah, we touched on that long-term process, right? If you know as an engineer and you as the technician you are, law of large numbers says over time, this iterative process is going to, probabilistically work out in our favor.
I think at the heart of where we've arrived now, we're talking volatility. Well, we were kind of talking directional regime, but let's talk volatility regimes. They struggle when volatility collapses. There's just not enough meat on the options.
Right. Yep.
And then, you mentioned Volmageddon just recently.
Yeah.
When some of those income funds just went out of business. How does volatility factor into what's important to what you do?
Extremely important. Extremely important. First of all, we mentioned the worst environment, which you said if volatility just dries up and we're up and to the right, VIX is in the low teens, we're just writing put premium and expiring, that's where we're going to lag. But we like volatility. You want that vol expansion, you want premium expansion, and you want that two-sided action. That's the sideways kind of market that I was alluding to. It is very important that from somewhere we're getting above normal premium collection if it's dry elsewhere. I think something that I want to mention here, two things really, where other firms struggle with volatility is covered call funds, by definition, right, have to own the underlyings that they're going to write the calls on. And thou shalt write covered calls by prospectus. So if you're already 100% long and you're writing covered calls, and most of these just do it on a very narrow area of the market, like a large cap growth or whatever it may be, you're going to experience the down in the 100% you're long. And then also, thou shalt sell covered calls by prospectus. So you're selling calls lower and getting called away lower, potentially, right? Then you have to get back in even lower. So this is where put selling in our minds has the extreme advantage of you get that weekly, bi-weekly, 45 days, whatever your duration is you'd like to have on the put side. You're giving yourself that downside buffer first, getting some income in exchange for that. Say, hey, I'm willing to buy here. Yes, it's X% lower, but you're not already 100% long from day one when you enter that position. And the other advantage is leverage. So we use no leverage by prospectus by rule. So we're only going to notionally allocate out to 100% of the AUM. Where I think those that do get in trouble is, hey, I got this margin, I'm going to write some additional puts and maybe lever myself a little bit, and that can get nasty really quick in volatility expansion.
Yeah, for sure, for sure. Earlier, you mentioned that there aren't really a lot of funds out there that are selling puts. It's mostly just the calls. And I wonder how much that ties into the advantage that you have, because to me, one of the biggest things about the WEEL strategy is the risk premium. Just that volatility has been shown to be overall on average overpriced somewhat.
Yep.
And because of volatility skew, the put volatility is higher. So, I mean, would you say that that's really one of your advantages, is that you're selling those higher volatility options?
Yeah, absolutely. That's one of many. I would say I wouldn't totally rely on that as a firm thesis, but as a firm thesis, we build out all these different advantages, that definitely being one of them, right? In a non-ZERP environment, which is kind of where this story started because my business partner Eric found cash secured put writing through his bond portfolio at the RIA doing nothing in ZERP, right? It's like, I got this portfolio that's doing nothing. What can I do? I can write out of the money puts on something that I really want to own and I'm willing to buy lower. And through that conversation, when I met him, we found out we had a lot in common and ended up building what this eventually became. So that out of the moneyness, that collecting something for waiting, and the willingness to step in later, the collateral is where I was going with that. We're now non-ZERP, we're off zero. So having that collateral in our hip pocket is getting some income while it's sitting there too, right? We're not just holding something in hopes of it going up. We're holding in a 40 Act fund, you actually have to have T-bills as a collateral. So there's many ways you could do this if you want to do it yourself as retail or as another structure. There's money market funds. There's all sorts of things that you can hold as collateral that will earn you something while it sits there and waits at the notional put amount, which we think is a huge advantage over the covered call fund.
Yeah, yeah, interesting. One of the things that I feel like I picked up on about you is that, and I think maybe we're similar in this manner, is that it seems to me that you are always trying to learn more and get better at what you do, right?
Oh, totally.
Yeah, yeah.
Every day.
And same, after 30 some years. What did you learn about options trading after managing real ETF assets, that you didn't learn before through studying or backtesting or whatever?
Okay. That's a tough one. I think where I want to go with this question is I miss retail trading. I'll tell you that. And pressing a button and having the trade go through is an overlooked advantage when you're retail or when you're another, form function. Trading in the ETF has many steps. It's kind of a little bit clunky, but again, the goal of this was to bring this process to maybe someone that looks at it and was like, hey, that's really interesting. That's super cool, but I'm not going to take the time to do that. Or I understand what you're trying to do, but I don't really want to get into any of the math or the options Greeks or the technicalities. The income looks great, and I would like to own that for $20 a share. And, as easy access as $20 a share, right?
Mm-hmm.
So I think I'm going to answer that as to the proceduralized logistics of how we carry this process out is much different under the hood in the 40 Act fund as compared to outside of the 40 Act fund. That's where a ton of my learning and streamlining has been in that process. But again, learning from folks like you and all the education out there, I still do that stuff daily because I don't want to lose that competitive edge where I almost feel a little bit of a slight fear, like I don't want to get behind in my knowledge or my learning. So I use that fuel, I use that energy to try to keep learning every day, and I certainly don't know everything. So definitely something new to learn every day.
As far as how you trade in the ETF in WEEL, how does WEEL differ from the way a typical retail trader would execute it?
So one of the things I mentioned was leverage. I think retail uses leverage, maybe even inconsequentially or unintentionally, right? I mean, you see, even back when I first started, one of the names that sticks out in my mind is Palantir, although it's grown in dollar amount now. But I'm using this example because back when it was like 10, 15, $20, a retail trader might look at that and say, oh, I can sell puts that on this very cheap dollar amount stock. I can use a little bit of leverage. It's already volatile. So that, you're stepping into a lot of potential potholes there. Whereas in a structured fund, there's a lot of things that keep me on the straight and narrow now, right? We have to strike a nav at every moment of every day because we're listed on the New York Stock Exchange. And when someone goes into that prospectus, I want them to see Rob and Eric do XYZ, and that's what the expectation is, and that's what they're going to get. So I think, again, that kind of helps me get out of my own head and be like, hey, we've developed this process. We're going to stick to the process. Can it develop more and better over time? Absolutely. And we can make those changes. But we're required to deliver this product to the investor with their expectation of the delivery of XYZ. So again, that kind of keeps me on the straight and narrow of sticking to the process. The put side is very rules based. We have some discretion that we use on the call side, which we can talk about that later, how we actually approach. But I think that's how retail versus the product would differ most is in a leverage type situation or a structure type approach.
Yeah. And actually, I'm kind of interested in that now. So the puts have a very, very rule based plan, but you have a little bit of discretion, I guess, with covered calls. How does that work?
So the way we engage the positions, again, by prospectus, we wanted this to be something that people could expect, right? We're going to diversify. If you look at some of these other funds in our basket of derivative income, they might do one or two things, or they might specify, or they might lever, or whatever. The goal of this product was it to be a core position, something that you could hold that had several forms of diversification, which I can step into that for a minute, actually. We're going to diversify across asset class, but not only asset class, across time, across how we engage, and the out of the moneyness will target a rate of return of what we want to see on the put side. And I've heard you talk about this to others. I think you kind of engage quite similarly, is you might scope a delta range and say, I like the probabilities of this on a 1 week, 2 week, 1 month, 45-day outcome, whatever that looks like to you, and sell that out with those probabilities in place, right? So, whatever the product might be, the volatility, expansion, and contraction are going to kind of drive what those expected outcomes are. So, even if you sold the equivalent delta in, let's pick a very boring utilities, maybe, or something that they're kind of sexier nowadays, I guess, now that we've aligned them with the AI boom. But a 20 or 16 or pick your delta out of the money put in utilities not going to return a 2016 equivalent delta in semiconductors.
Yeah.
So we kind of look at that again. We developed what this looked like over time to be like what asset class is punching above its weight class, how can we structure the portfolio, whether that's, we're honestly a little narrower in tech because you can, again, you can use that allocation on a notional basis, but still get the income you want by sizing your deltas and working that expected return on an annualized basis. So we took the portfolio and we said, okay, how much do we want in tech? How much do we want in financials, healthcare, utilities, down the list? So we allocate across sectors, and these are optionable sector products. And we look for that out of the moneyness. We accept what that annualized rate comes in at. We lay those out and we receive the income. And if the market comes in, what's important at this stage is the uncorrelatedness of the underlyings that you're using. And this is actually very pertinent to what's happening right now in the market because you get something like financials that are actually have been doing quite well this past couple of days with the broader, tech names selling off. And so we want to keep that income engine moving somewhere in the portfolio. If we're assigned some tech, I wasn't assigned financials, I can regenerate those puts next week or bi-weekly or whatever the time frame is. So those are kind of some of the things we're looking at on how we allocate. And I had mentioned a timing component to it as well with Qs and IWM specifically are now daily, as you know. They have daily expiries.
Yeah.
So one thing that I have implemented is not only an asset class diversification, but a time component intra to those items that have daily expiries. So take an IWM for a specific example. I might lay out part of my position on a Monday morning for a Friday expiry or a two Friday expiry, and then I can wait the week and see, okay, well, it's Wednesday morning. The market's come in a little bit. I'm going to go ahead and outlay the rest of my notional exposure to IWM. And that allows a time advantaged diversification intra to that allocation as well. So again, we're using kind of the uncorrelatedness, a time component to try and keep that put engine moving somewhere to keep the income flowing on the put side.
So any shares that you hold in a particular name, you're not necessarily always fully allocated covered calls against that on a one-to-one, right?
We may potentially be. The,
Okay.
the intention is to not to initially, or, our out of the moneyness is such that hopefully, A, it expires worthless and we keep the premium.
Mhm.
Let's say in that IWM case, the market does come in and I'm assigned IWM because I have that second chunk or tranche of notional exposure to average lower. Eventually, maybe the market just keeps coming in, and we're now long that full notional amount that was allocated for IWM. I may just eventually fully get assigned my IWM position. But here's what's cool about the product as a whole. We've said, okay, let's say all correlations go to one, and we have just a disaster over a couple of weeks. The worse this looks is a diversified basket of assets across many sectors that is now covered call fund. So we own the products. We missed the initial drop on those products, so we got to buy lower. And now we're generating income on the covered call side. And that may look like a couple different things. If we're barely assigned, we may be right out of the money just a little bit to get a little bit of capital appreciation on that name, or the market environment is such that we think we might be going down some more. So I'm just going to write right where I was assigned and experience that now super juicy covered call premium. Get that as often as we can until it either doesn't make sense, or maybe I have to go out 2 weeks, a month on that covered call. We're going to hold that product and we're going to write covered calls to get income from the call side. So hopefully what I just described allows a full picture of the WEEL process from all cash to selling the out of the money puts to most likely at some point getting assigned some underlyings to owning those names long, writing the covered calls until they're called away.
To me, this kind of segues into a related concept that it's just been on my mind since we've been talking here. I know, like with me, I trade the wheel in my IRA, and the IRA is however many dollars are in it. But with an ETF that grows over time and such, what's the hardest part about scaling a wheel strategy with a public ETF like this? Liquidity, execution, position sizing? How does that work?
Great question. It's definitely a change and was a learning curve from being a retail trader to striking an NAV every day and stating that, we seek to provide a dividend, right, is the functionality of the product. So if we say we're seeking to give a quarterly dividend, what does that look like if flows come in, come out? That is managing not only the dollars, but the position sizing when we put things on, managing what we're holding for that quarter. So we seek to generate a quarterly dividend. And we did that specifically because that helps us manage those flows over time. The intent was to move the income to the final investor. So you brought up an amazing point about dollars coming in and coming out of the fund that, as any other type of structure trading this process, doesn't have to deal with that, right? You kind of know what the account size in is. If we get an investment, which is called a create, or an open-ended ETF by structure is how it's phrased. So if someone invests in our fund, the market makers will create a block of shares for the WEEL ETF. And we get those shares to trade. We get those dollars to trade. So over the time frame of a quarter, as money flows in and out of the fund, we kind of have to dynamically size what the optioning positioning is to generate enough income to hit our target goals, right? So we seek to generate 60 cents a quarter. So we sit there and we say, okay, here's our share count. Here's what we got to generate per share. So what does that look like on the allocation structure so that we're generating enough income to spit out the dividend we would like for the end user? So that's been a delicate balance again of the allocating, the structure, where we seek to generate the income and where we don't. Because again, maybe some funds have to leave,
Mhm.
which is called redeem. We've been lucky enough to only have one redeem in our 2 year track record now, which is a little bit of money flowing out. Luckily enough for us, what's cool about the process is we always have some cash in our pocket, right? Because the collateralizedness of the out of the money puts keeps us at some type of long exposure and cash exposure. So if there's a redeem come in, we just make that adjustment at the end of the week or the end of the bye week. Some puts expire before we reallocate on the next trading day. We'll look and we say, hey, there were some outflows, so we got to adjust these positions down to the new size of the AUM. So again, no leverage being used. So if dollars leave, we kind of narrow down those positions to stay in line with the AUM. If money comes in, that's a great problem to have, right? We're growing, but now we have to allocate those dollars into the program so that we're generating the income on those dollars to seek to kick out the dividend at the end of the quarter. So
Yeah.
that's been the most challenging part, I think, is kind of the intricacy and again the tight wire rope we walk to deliver that.
Yeah. And just at your target dividend of 60 cents a quarter, which it looks like 2 quarters ago, you actually paid a higher dividend, right?
Yes,
Yeah.
that was December, right?
Yeah.
So the 40 Act says, again, thou shalt distribute all short-term income,
Oh,
right?
yeah.
So 60 cents, 60 cents, 60 cents for the first 3 quarters. We probably, idealistically, we've been walking that tightrope enough with the allocation sizing and where we're getting this income is we might have a little bit extra at the end of the year. So we give the extra out in that December dividend.
Mm-hmm.
So all else equal, barring that the product acts as we intend for it to act, that December dividend is going to have the 60-cent target plus anything extra that we made throughout the year that we give as, I could say bonus, but it's not a bonus. We made it, so we're going to give it to the investor.
I mean, that's a pretty good return. I mean, it's 12% on something that has much lower but Sharpe ratio, I would guess. We haven't really talked about that, but
Our Sharpe is pretty good, and we like to talk about beta and beta to SPY to BXM or like a PUT. We actually, the closest thing we could come to a benchmark in our minds was 50% allocation of the put right index and the 50% allocation of the covered call right index. So that is our benchmark. But nobody says beta to some weird benchmark, right? They say when you say beta, you mean to the S&P 500. So our beta to SPY is 0.51 right now, which we're really proud of. That's generated from, again, the out of the moneyness buffer we're utilizing on the put side
Mhm.
and the diversification of product allocation so that, again, we have income coming from some portion of the portfolio on the put side and generally some covered call income, some T-bill income. So that is all going to roll up into that 60 cents at the end of the quarter.
I wonder if you could share a little bit of breadth of knowledge on how ETFs, especially an ETF like this, functions for people who don't know. How does that all work, and how does NAV fit into all this?
This is a capital intensive to do this properly in a retail function. If you wanted to do exactly what we're doing, what you can totally do it.
Yeah.
But it's very capital intensive, right? Let's say you wanted to write one contract on the Qs. The Qs are trading $700. That's $70,000 collateral. And that's
Oh,
just one position.
yeah.
Your notional exposure is $70,000 on one Qs contract. I don't want to do just Qs, I want to diversify. So now
Yeah.
you got to do some other things. And then we're also an RIA. We have an RIA umbrella where we do some wealth management, which is Eric's business. So if you stack all of these things on top of each other, you got to have pretty sizable available dollars to do the strategy effectively with no leverage. And that's where the idea came from. Oh, how do we fix that? We make it a bucketized product that anyone has access to for one share price. So whether Rob Pascarella buys one share or Goldman Sachs buys one share, there's no differentiation. It's still dollars to the bucket that we then put into the program.
It's interesting when you get under the hood there and start really looking into it. So here are a couple of things that I think would be really kind of interesting to talk about. 5 years from now, what would have to happen for you to look back and say, man, WEEL was a major success. We did it.
I tell you, it's been a ton of work, almost surreal to look back and see, everything we've done in a short time frame of getting where we are today. The first thing, which has already happened, was getting to ring the bell at the New York Stock Exchange. I don't think it was really solidified in my mind that this was happening until that moment happened. It was just such a euphoric experience you study this stuff your whole life. You see it on TV every day. To be there and get to do that and just like live in that for a moment and be like, wow, this is happening. It really just makes me so grateful. And again, it gives me even more fuel to drive forward and want that next step, right?
Mm-hmm.
But in 5 years, I don't know. I guess we truly think this product competes as a core holding in again, one of our theses is 60/40 is dead, right? So you could take some of that fixed income allocation, some of that equity allocation, and have this as a sleeve in client portfolios that are giving them a low beta product that is kicking out income that really gives, again, that diversification on a holistic look and a holistic look to a client portfolio. And 5 years from now, I would really like to say that we've achieved some type of acceptance from a broad-based name your firm uses this as their core holding in that for that allocation, right? Launching another product. We have tons of ideas. It turns out this is quite expensive to launch a product. We have tons of ideas, but 5 years from now, I'd love to have some more products or a different version, or, we have lots of ideas to kick out for subsequent products. But I think those are some things in 5 years that I would like to say solidified our presence.
What do you think the biggest risk investors are ignoring right now?
Biggest risk investors ignore. Two things I'd like to say, really. I kind of mentioned it earlier, is when you delve into this as a new trader, there are a lot of potholes that you may not realize. And I think rather than giving you this area of the market is overvalued, which we could talk about. I mean, there's lots of data. We actually have an article on our site that it was originally an LPL study, but JP Morgan has done some data on S&P 500 valuations and subsequent returns a year out and a decade out.
Mm-hmm.
So I think the study started in like the one we published, again, it's on our website, starts in like the 80s. They observe an S&P PE and you look out a year and you observe that return, and you look out a decade and you observe that return.
Oh,
And the premise is, what does PE tell us about the next 12 months?
yeah.
And it's a cluster, right? The R squared is like obscene. There's no correlation. But if you look at the second chart of what's S&P PE correlation to the next decade returns, the JP Morgan study might be 5 years, but they basically show the same thing.
Hmm.
Very linearly represents something that everyone should be looking at right now, where valuations are and what time tells us the next 5 or 10 years should be. That is one thing I guess I could say, but I wasn't going in that direction
Hmm.
of what's overvalued, what's undervalued. That's a hit or miss anyways. I think risks that investors don't see coming, or I think you mentioned it as, I forget how you said it, overlooked, that investors overlook.
Yeah.
I would really, again, use the energy of the education and dive deeply into your field of expertise and make it your own. And the risks that you aren't going to see is following others blindly and not investing in yourself and understanding your trading strategy enough and believing in yourself that you're going to have that longevity. I guess that's what I would say about not necessarily market risk per se, but risk as of just following the herd.
As we wrap up, I think about how much you accomplished in such a short time, you and your partner, and just really massively impressive. So, if a 25-year-old trader wanted to be sitting in your seat 5, 10, 20 years from now, what would you tell them to focus on?
That's a great question. And I think I would say not only am I an engineer, I'm an introverted engineer. So I don't particularly, I'm not good at these things. I'm not, I'm not a networker. I'm not comfortable in those kind of environments. I would have liked to see my younger self really network more, ask people like you more questions, get out, expose yourself to how the industry works, not just sitting and educating yourself is certainly goal one. I wish I would have asked a lot of more questions, networked a lot more earlier, and just get that exposure. Like, I think, maybe you just feel like, well, I'm outside of the industry. I'm not an insider. I don't really have any business asking this person a question or this person of a certain status or involvement a certain question. I have found those thoughts of mine to be not true in the long run. Anyone like you, I come to you, you and I could talk about this stuff all day long and we'd both enjoy it, right? And I think that's more of the truth than what I had in my own head at that time was I'm just going to sit and learn and not bother anybody. And I think getting out there, questioning, finding what resonates with you, finding someone who believes in your attitude and your goal structure and helping you achieve those goals. I now have a system of mentors that I wish I would have had back then. Mentorship is huge. And that's something that I wish I would have pursued much sooner. So that I think that would be my piece of advice.
Well, excellent. I really enjoyed this conversation, and I'll tell you what, I'd be up for chatting anytime you want.
Same. Yeah, this has been really great. And again, it was a huge honor, and we definitely will.
Rob, thank you so much. Rob Pascarella.
Thank you, sir. Take care.
And that about wraps it up for this show. But before you go, make sure you are subscribed in your favorite podcast app. And please leave us a review. We would love to hear what you think about the show. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.